Why did so many apartment complexes lose money in the last few years, or at least not make the kinds of money they were anticipating making? What went wrong? This is a question a lot of investors are asking right now, and they're worried that it's still going on. They don't know if we're past it or not. And so I was doing some coaching the other day where we actually dug deep into this and I went over the exact numbers, exactly what happened. It was not one thing that caused this to happen. A lot of people are blaming the operators, saying they did a lousy job. For the most part, that wasn't the case. I'm not saying there weren't any operators that did a bad job, but most of the time it was a compilation of a bunch of factors that came together all at once. And that created this storm where a bunch of properties lost money. Hopefully, you're not in any deals that lost money. But it's important to understand why that happened, why it was a like once in a lifetime type of event that we don't expect ever to happen again, but also so you can see where we are now and how things are very different now, and why I feel like we're at the bottom of this market cycle. And now is actually a really great time to get into deals because there are lots of opportunities. Sadly, because some of these properties got into a distressed situation, now have to sell, but you can buy them at a low price right now. And when you're at the bottom, there's only one way to go, right? So, but it's important to understand the numbers behind it. How did they get in trouble in the first place? And what are operators doing differently now than they did back then to ensure it doesn't happen again? For one thing, operators, for the most part, are holding a lot more reserves in case anything goes wrong, and banks are requiring higher reserves. So those are two safeguards that are already in place, but there's a whole lot else to it. So check out this video where I just took a little snippet from that coaching to show you the exact breakdown of the numbers so you can understand what happened between, say, 2020 and 2025 and how are things very different right now. Check it out. Yeah, today, yeah, like I said, I was just out in San Diego and I was there for a mastermind event. So I was actually going to share some of that information with you guys because a lot of it is very relevant to underwriting. And now, many of us are getting together to raise for some deals. And we're going to get some questions from our investors about, well, what happened with the market? Why did some of those other deals not perform? How is this going to be different? And how does the underwriting compensate for that? So that's kind of what I was going to hop into today a little bit. And I actually took some pictures of some of the slides that were on the screen. So I'm just going to share those instead of recreating my own. It's cheating. I'm cheating, guys. Um, but yeah,
It's
so so Tim
smarter, not
Brock,
harder. Yeah.
I'm sorry, what?
It's working smarter, not harder.
There you go. There you go. Yeah, so this was the Legacy Family Mastermind. I've been a member of it for 5 years now. And Tim Brotz is the organizer of that, or he's the leader or whatever. And he bought properties all over the country, scaled really large, and then had some problems across the portfolio. So he took a look at his portfolio and that of a bunch of other sponsors, basically, and kind of compiled what happened with all of those. So he has not lost any investor capital, which is impressive. And but sometimes that meant that he was writing multi-million-dollar checks to the deal to keep him afloat because he did not want to lose any investor capital. So kudos to him for doing that. A lot of sponsors would not be willing to do that or would not be capable of doing that. So that's one thing that when we're vetting sponsors is kind of understanding how financially found they are and their businesses are, and if there is that willingness to put money where your mouth is if it comes to that. So anyway, he put together this slide. So I want to give him credit for it because it's not mine. But this was a deal for 2020. This is what that deal looked like, right? So this is a deal where the potential income there at the time was $1.2 million. They underwrote for 10% vacancy, which is pretty good. And then they had the collected rents, right? And then they had your typical expenses of your taxes, your insurance. Maintenance at the time was 10%, management at 10%. So the net operating income was $609,000. And so at a cap rate of 6%, which was what this property yielded at the time, the evaluation there was $10.15 million. So and he kind of took us through some of the changes and how even though income goes up, that valuation does not. So let me see if I could get to my other slide here. I'm gonna zoom in on this one for you. So same property, now looking at it in 2025. So if we start at the top again, you see the potential income went up. So it had a 15% income increase there. And when he looked across the portfolios, his own as well as others, that was about what the rental increase and potential income increase was. It was 15%, which is a lot. So that's great. Vacancy about the same, but look at your expenses. What happened on your expenses? Taxes across the board went up 23%. Insurance 1 to 200%. Here in Florida, we hit 300% sometimes. I mean, just
Wow.
insane, right? Your utilities went up. Maintenance went up. Remember labor and all the shortage of supplies and what we're paying for lumber at the time? I mean, that kind of stuff was insane too. All of that hits your maintenance budget. And management costs went up because everybody had to be paying those higher rents and higher costs of just living in general. So everybody ended up having to pay their workers more. And so when you do all that, it does not make up for the increase in income. And so the net operating income was actually less. So that decreased the value of the property by about $110,000. And I say, okay, that's not the end of the world, $110,000, but it's less than where you were in 2020, and you expect 5 years later for this property to be worth more, not less. But it gets worse, guys. So, oops, wrong way. Look at the cap rates. The cap rate also expanded, right? Instead of the contractions we had been seeing, we got an expansion of the cap rate. So huge difference when that cap rate becomes an 8 instead of a 6. And that was primarily because of the interest rates, right? Interest rates went up, so everything was more expensive to buy. And so hence the cap rate tends to go up too. So now you've got a property that's 5 years later, you've been doing all this work, all this operation, been taking no income from it, and now it's worth over $3 million less than it was 5 years ago. This is what was happening over and over and over again. So when we're explaining to our investors, what happened then and what caused these things, it wasn't one factor. It was a lot of factors. Obviously, a lot of it was tied into COVID, but there's a lot of other factors that played in here. Those insurance prices had nothing to do really with COVID. It did have something to do with the cost of properties going up because of that, uh, what's the word I'm looking for? But where the interest rate had been artificially reduced for so long that people were buying at insane values, right? So that made the values of properties go up. So insurance does go up when property values go up
But
because
quantitative
they have
easing,
interest.
Maria.
Thank
Quantitative
you.
easing, QE. Yeah,
Yes. Yes, thank you.
sure.
That's what wasn't clicking in there. So we do have that, but obviously it was a lot of storm damage and a lot of other things that happened at that same time. So you just had to put all those factors together. And the fact is now the properties we're buying now, we're getting them at those higher cap rates. We already know what your maintenance and your taxes and your insurance currently are, and they're starting to come down. We're seeing the reverse happen now, right? We're being able to fight taxes and get them reduced. We're getting lower insurance. One of my insurance is on one of my apartments. It dropped last year a little bit. It dropped substantially this year, and now I just got a quote for next year that's even lower than this year. So we're not back to 2020 prices, but they are coming down. So we're seeing the reverse of all these things happen now. I think utilities are still up. Maintenance, as far as your people component, is still up. But the difference is we know them now, so we have them in the underwriting. We're not assuming the 3% a year increase, which is what we normally had, all of a sudden going to these really high, crazy rates, right? So that's the big difference there. I just got a text message that said the mastermind is getting this hero mastermind is starting. I was like, what's happening? Um, Yeah. So does this help a little bit when you're talking to potential investors to explain and kind of try to ease the fears? I mean, it won't ease their fears for deals that they're in already. I'm in a lot of deals from 2020 that aren't looking great, but I'm optimistic for the future. We're just gonna hold longer, but this is also why a lot of them couldn't refinance then, right? A lot of them had plans to refinance, but instead of being able to pull capital out at refinance. Some of them were forced to refinance because they had bridge loans that were ending, right? They only had a 3-year term or something like that, and they didn't have the option to extend. And so in those cases, now you're having to refinance a property that is worth less than it was when you financed it in the first place. So you're doing cash in instead of cash out refinances. So if any of you were wondering how that happens, this is how that happens.